Tonight I'm going to talk about redefining risk because I do believe that the industry has it wrong. So Captain Obvious says, everybody knows who Captain Obvious is, right? You should only take as much risk as necessary to meet your financial planning goals. We all know that. We're told that every single day. But yet very few people actually do it. It's just like losing weight. How do you lose weight? It's very simple. You eat less and you move more, right? But again, very difficult to do because we lack discipline. I am going to postulate this evening that most investors don't know the true risks they experience with their investments. And what's more, I'm going to make the argument that most advisors don't understand risk either. So tonight I'm going to challenge what you think you know about risk and broaden your perspective. So everybody knows these things, but we don't do it. So let me start out with a very simple question. What is risk? And this is the part where people answer. What are your guys' views on risks when it comes to investing? The exact definition is the potential for loss or less than expected rate of return. That's what we talk about risk, or how we talk about risk in investing. As you get closer to retirement, the risk becomes a little bit different because it's a risk to your lifestyle. It's not just a loss in your investment portfolio, it's you not being able to maintain the lifestyle that you want to. So that's the risk that you get to look forward to as you get a little bit older. We've all heard this expression, right? There is no risk-free investment, and it is true. Every type of investment out there has some type of risk associated with it. So, another question for you. Which one of these three investments would you like to have? Which one is best? It's hard to tell, right? This is how most people pick their investments. They look at the return. When you talk about return in investing, you're only talking about half the conversation. You've got to talk about the risk associated with your investments to get this return. Now, which one of these is the best investment? Anytime you talk about returns, you've got to talk about the risk you're taking to get those types of returns. And just like there are different types of risk, there are different ways to define risk in investing. So how is risk calculated? Risk is based on historical events, right? Actuaries, insurance companies, they all look at how many people traveled in a car versus how many died. How many people live to a certain age, and that's how they figure out how to price life insurance policies to remain competitive and profitable, because life insurance and insurance industry is very, very competitive. We've all seen this, right? If you've ever read your investment statement, past performance is no guarantee of future results. Although it's not a guarantee, history is how we determine risks. So there are different ways to calculate risk. I'm not going to talk about all of these tonight, just the first and the last one. Standard deviation is the norm in the financial services industry today. And I'm going to show you why that may not be the best way to define risk. Even though everybody does it, I think there's a better way. Downside deviation looks at standard deviation, but only looks at the negative portion of it. Sortino ratio uses downside deviation and an acceptable rate of return to come up with a ratio that some people use. It's pretty complicated, not very many people use it. The Sharpe ratio is used when you're comparing two investments. You get them to the same level of risk, and then you can compare the returns based on that same level of risk. It's a way of comparing apples to apples. These two are a little bit more complicated than these two, but they're a little bit more accurate. And then the last one, maximum drawdown, is what I'm going to introduce you to tonight. And I think you'll see by the time we're done that this is a much easier way and a much more accurate way to define the risks that you're putting your portfolio being exposed to. Standard deviation looks like a bell curve. Standard deviation, by definition, is the variance in returns from the average rate of return. It measures volatility. How much plus or minus any given return is in a year from your average rate of return. So what this looks like is you have the average or your mean. You've got a 68.3% chance of your any given 1 year return being within one standard deviation of your average. You've got a 95% chance that that annual return will be within 2 standard deviations. And then a 99% chance that it will be within 3 standard deviations. An example will make it clear. In our example, we have an average rate of return of 5% with a standard deviation of 10%. So your average is 5%. One standard deviation means you've got a 68% chance that that year's returns will fall between -5 and 15%. Everybody with me so far?
Okay.
You've got a 95% chance that that year's returns will fall within -15% and plus 25%. 2 standard deviations. And you've got a 97% chance that it will fall between -25 and +35. Does everybody understand that? As you can see, not all of these returns are negative. Half of them are positive, right? Because it measures the volatility from year to year. So my question is, if you get a higher than expected rate of return, is that a risk? Would you consider that a risk? If you're expecting 5% and you get 10%, are you going to call me up and say, Nick, what the heck are you doing exposing my portfolio to this amount of risk? I got higher than I expected. No. You're going to brag to all your friends how smart you are, right? You're not going to consider that a risk because this really isn't a risk. Getting better than what you expect is not a risk. It's volatility, it's a variance, but I don't consider that a risk. So the term I want to introduce you to tonight is maximum downside, and it's very, very easy to understand. It's from peak to trough, from top to bottom, the highest value to the lowest value. It's not annually, because we don't invest from January to December. We invest for 5, 10, 20, 30 years, right? So why should we measure risk like that? I'll tell you why. If you don't put it annually and you do the maximum downside, it's scary. It can be scary. And I'll show you why. For example, October 19th, 1987, better known as Black Monday, the Dow Jones Industrial lost 22% in one day. Is that scary? You better believe it. Do you think people invested in the end of 1987 and 1988 that got burnt on that? Let's look at a more recent example. This is from January 2000 to January 2015. And I use highly sophisticated financial software for this. It's called Yahoo Finance. Or anybody here from the South, it's Yahoo Finance. But no, anybody can look these up. As you can see, this is a mountain chart, what we call a mountain chart. It's the returns from year to year. And it goes again from 2000 to 2015. What you can see here, from 2000 to 2002, the S&P lost 46%. But yet, when you look at the individual years, the worst year was 2002, which was 22%. That doesn't sound too bad. Which would you rather have as an investor? Your financial advisor calling you up and saying you lost 22% in 2002 or 46% overall? And then again, what everybody remembers, October 2007 to March 2009, it wasn't just the 37% people lost in 2008, like the news tells us and everybody tells us. It was 52%. If you had $1 million portfolio, it was now worth $520,000. And you were looking for somebody to hang. Because that hurts. So that's what maximum drawdown is. Very simple to compute. Very simple to understand. A true measure of risk, in my opinion. Maximum drawdown is part of the pain index. The pain index is comprised of 3 parts. The frequency, or how often you lose value in your portfolio. the duration, or how long you're in the red, and the depth, or how much value you actually lose in your portfolio. From 1994 to 2014, the S&P generated an average rate of return of 5%. But yet, during that time, investors risked more than half of their portfolio to get that 5% rate of return. So if I came to you and said, hey, I've got a great investment, it averages 5%, but oh, by the way, you have a chance of losing half of it, are you gonna take me up on that? The next part of the pain index is duration, or how long it takes for you to recover from that downturn. The downturn of 2001 started in August of 2000. You didn't get back to zero until May of 2007. That's almost 7 years of being less than zero. And then what happened? It dropped a little bit, and then everybody got happy, and then what? October of 2007 hit for the big one. It was another 5.5 years before you made up what you lost. This is an index. It doesn't take into account any management fees that you're paying or any costs associated. Or, God forbid, if you retired here and you were taking 4 or 5% every year to live on, chances are very good if you retired in this time and you were taking that money out, you were still in the red. But yet, this is what we lived through. Now, everybody thinks, or most people think, that if you suffer a 10% loss, all you need is a 10% gain to get back to even, right? It's a law of averages. Negative 10%, positive 10% equals zero. It doesn't work that way in investing. If you suffer a 10% loss, it takes 11% to get back to even. A 20% takes you 25% gain to get back. And if you lived through 2008 and suffered that 50% loss, it takes a 100% rate of return just to get back what you lost. It's not averaging, it's actual rate of return. And that's where we're being misled by the mutual fund companies, because they use average rates of return because their portfolios look better. If they told you the actual rate of return, very few people would put their money with them. So my question is, what's your current strategy? Are you well diversified and taught to accept what the market gives you? Because that's the way most of us are taught. That's, all the talking heads, or a lot of the talking heads on TV, that's what they're saying. Or would you like to have some type of downside protection to limit those big losses in your portfolio?